Hello everybody, I'm Cantonese Cat. Hey everybody, Cantonese Cat here. The Federal Reserve, Jerome Powell is going to come up this afternoon. There's going to be a rate cut decision either by a quarter of a point or by 50 basis point. Whatever. I honestly don't really care what they say. The federal funds rate, the effective federal funds rate has really been maintained around 5.3%, and that really has been since August of 2023. Has anything crashed from rates being too high for too long? The answer is no. Other people having a lot of recession fears and want the Fed to cut sooner because of that? The answer is yes. Does it matter whether or not they cut, how much they cut by? Is this going to be what is really going to ease financial conditions, or is the market already pricing in? Is already easing financial conditions? I personally think that the Fed doesn't matter, because even though the effective federal fund rate is still at 5.3%, if you just look at the 2-year yield, it maxed around 5.3%, but the market is already easing financial conditions. You can see that it already maxed out October 2023. And since then, the 2-year yield has really plummeted all the way down to as low as 3.5%. Right now, it's kind of fluctuating around 3.6%. Same thing with the 10-year yield. It was as high as around 5% or so, and right now it's around 3.7%. If you're looking at the 30-year mortgage, you look at the mortgage rate, you can see that it peaked out around October 2023. It's around 7.8%. And right now it's really slumped down to about 6.2%, right? So you can make an argument that financial conditions has already been eased because the market has already adjusted the rates that you get simply based on bond demands, based on real market conditions, rather than just a bunch of stuff that these people up in the ivory tower like basically telling you, oh, we have these dot plots, we have all this stuff. Like, I honestly think that it's cute, but you're gonna put a lot of people gonna pay a lot of attention because people are narrative driven. They're gonna always want to have somebody to have like an authority figure who can really tell you what is going on. But the reality of what's going on is that the financial conditions has already eased by itself. And there's also a second thing too about people asking whether or not the start of a rate cut cycle is going to lead to any recessions. And there are people who says that every time, or majority of the time, whenever you have the Fed's cutting rate, is going to lead to the stock market or the overall markets to go down. It's going to lead to a recession. I don't really see the data for that to be supportive of it, so I went back, and I went back months ago actually, and this is also something I just went back a couple weeks ago to really try to see whether or not there's any correlation whenever there's going to be a rate cut cycle starting, that the stock market just crashes. Quite to the contrary, actually, every single time when the Fed cuts, or starts to cut, that's when the S&P 500 end up having a huge rally pretty much immediately, right afterwards. And that has been pretty much not failing for about 50 years, with 2 exceptions. Now, these 2 exceptions are going to be what strokes the most fear, and they're going to be basically what everybody's going to focus on, because people like fear, people like being scared, and people like scaring other people to get the reaction out of people. It's what drives pretty much YouTube views, is pretty much what drives the media. The reality is this. Look at this. Does it look like every single time when they cut rates, the market plummets? The answer is no, with 2 exceptions. One is the dot-com bubble. The other one is the Great Financial Crisis. And I would argue that both of those scenarios is not because the federal fund is going down or starting a rate cut cycle. Is because things are just way over leveraged at that time. There's just way too much margin. People were piling in 5 years straight for the dot-com bubble, and it just was very unsustainable, and it needed to deleverage. And when it deleveraged, the Fed decided to cut to allow the deleveraging to have a little bit of a softer blow, right? On the Great Financial Crisis, it was also an area where things were just way over leveraged. And it's not so much from the S&P 500 side. from the Great Financial Crisis. It's more coming from the housing bubble side, right? You have multiple people just taking up multiple loans that they're not supposed to, and they just get in debt from all these banks who are giving out irresponsible loans. All of that stuff needed to get flushed out. All of that stuff needed to get flushed out. So what happened was the Fed did end up lowering rates to try help to ease financial conditions during those times, but it has nothing to do with the fact that they're cutting rates. Like cutting rates leading to recessions, leading to the stock market crash is a myth. It's an absolute myth, and I don't want to hear that crap anymore. Now, does it mean that this Fed cut cycle is not going to lead to a recession? It might still end up having a recession. You're going to have recessions. That's what the economy does. You're going to have booms. You're going to have busts, right? But is it because the federal funds rate going down is going to end up being a signal or triggering the S&P 500 going down? The answer is no. So please just be thinking critically and look at the data, which I'm presenting to you, and think about what you're looking at and think about what other people are saying and make the best decision for yourself, because I can be completely wrong here. The other thing to also consider too is if we are really going through a liquidity crunch, which I don't think we are, because if you look at the financials, they're actually doing extremely well. This is the XLF. If you think that we are going into a recession, you think there's going to be a liquidity crunch, you're not going to have like a straight, like from October all the way up to September with a big giant run up of like almost like insane run up over here, like 50% up within like a year for bank stocks to just shoot up like this. This is not something that would be warning of recessionary. Now, back in October of 2023, or even back in March of 2023, there were talks about banks failing, and there are some banks that did fail, right? But does it really look like that's really what's going on anymore? If banks are not failing, where's the liquidity crunch coming in, right? I don't understand that. Another thing too, if you look at regional banks, if you look at the another ETF, the KRE, there were a lot of fears that the smaller banks were going to go under around mid-2023. They didn't, right? Made a very nice double bottom, did a little bit of a back test. Right now, it looks like even regional banks are just forming higher lows and higher highs. Like they're these people who are in the know, they're not wanting to sell off regional banks anymore. These whales, they know everything. They're not selling off regional banks anymore. I mean, right now we're at resistance, but like, do you see what I'm talking about? I mean, it's kind of a little bit frustrating sometimes to carry these points. So I just don't see whatever it is that they're saying is going to come, that is going to come. I just don't see it. I think that most likely the stock market keeps going up higher, and if you're having a rate cut cycle, if banks are not in trouble, and I think that most likely we're, and things are also not really that over leveraged right now. Like margins not really like near where it was around 2021. You don't have these crazy irresponsible bank loans, with like houses. So I don't know what these people are talking about. On top of that, you also have rising global liquidity. Now, this M2 Global Liquidity Index is calculated based on the M2 money supply from the US, from China, from Japan, from Europe, and from the Great Britain. And you just have a breakout of global liquidity. Now, you think, you have a breakout of global liquidity, but how come stocks not rising? There usually is a lag. And even like there are a couple of reasons for that. One is maybe because we kind of front ran that for like a whole year, 2 years straight, and Bitcoin's already gone from like 15,000 all the way to like 70,000, 72,000, and right now we just needed to cool off. The global liquidity was slow to get injected. We just had to break out, so maybe it's just needed to cool off. The second thing is the whales going to play their games. They're going to rotate things around, and Bitcoin had its run, is just cooling off. Whereas the other stuff may not be, right? You're also going to have whales playing games saying that, hey, global liquidity just broken up. Why don't we try and take your Bitcoin? Why don't we try and take your altcoins away from you, right? Why don't we try and take these things away from you ahead of time so that we are positioned well enough to capture a majority of the gain that could be coming? That's kind of what I'm thinking. Again, I'm just making stuff up. I'm a cat. this is not financial advice. It's a little bit of a contrarian view because I don't think most people really think this way. The way that I'm thinking is not the usual way to think. But it doesn't necessarily mean that I'm right and they're wrong. It's just another way to think. And I just want to voice my voice in terms of what's happening because nobody really knows for sure. And the CNBC folks have been getting wrong for like 5 years in a row. Probably longer. But I just want you to have your own critical thinking in terms of what is to come. Be careful who you listen to. And remember that every single time when people talk about downside risks, there's also upside risks. Anyway, I'm done talking. Thank you so much for listening. We'll see what happens today. There's going to be some volatility. We'll see what happens, but thank you for listening. Have a good one. Bye.